Welcome to part 2 of our webinar on how to maximize your Social Security benefits. And so let's just get right into it because I think it's actually so important for you to understand what's going on here. And we're going to start off where we left before, when you should apply for benefits. We got to know what your benefits are. The PIA we talked about, primary insurance amount. We got to know what your AIME is, your average index monthly earnings. Your AIME leads to your PIA. But now we got to figure out when you should actually apply. And it really comes down to, I think, a lot of things here. Your life expectancy and your health. If you think you're not going to live beyond the age of 78, you need to apply ASAP. And the reason I say 78, because that's the break-even point for Social Security. So if you survive beyond 78, you will make more money by delaying your benefits. That's just there's no debate on that. If you are in bad shape, then you're not going to survive to 78, then you should take your benefits now in order to get something from it for sure. Now, there's other things that go on here. Survivor needs is critical right there. Survivor needs, we're going to talk about survivorship for your spouse, your surviving spouse. But for just right now, we're going to consider health status, life expectancy, survivor needs. These other things are fine. But these are the most important ones. Health status, that kind of goes into life expectancy, then survivor needs as well. All right, so that's kind of a rundown of what we're looking at. Remember, 78 is the break-even point when it comes to Social Security. We talked about delaying benefits. The more you delay, the more your income is going to be. And so here, if you take it at 62 and your PIA or your FRA is 66, FRA again is full retirement age, you're going to get 75% of the benefit. All right. And it just kind of goes down. And here we're assuming a PIA of 2,600 with 2.6 annual COLA. So if you take it at 62 with an FRA of 66, you're only going to get 1950. You fast forward. Let's see here. Yeah. Here, if you wait until you're 70, you're going to get 3432. But watch the difference here. I mean, what is that? It's $1,500 a month difference. So if your PIA is $2,600 and you take it early, you're going to be $1,950. If you take it later, you're going to get $3,432. Don't forget, these also get adjusted with inflation as well. So $1,950 at 62, which means if you wait until you're 70, that $2,600 PIA would grow to 2881 by these 4 years, 62, 3, 4, 5, 6, by the 62, 3, 4, 5, 62, 1, 2, 3, 4, 5. So those 5 years that you wait, that 2600 PIA will grow to 2881 because of the 2.6 cost of living. So again, let's just say you're 62 years old right now. Your PIA, FRA, full retirement age is 2600. You say, well, I can take my benefit now and get $1,950 a month. Or I can wait till I'm 66 and that benefit will actually increase to $2,881 because that 2.6 cost of living adjustment. Or I can wait till I'm 70 years old and not only my benefit grow at 132% because of the delayed earnings credits, but with a cost of living adjustment, I'll actually get $4,214. Now, it's not quite this is also going to grow too at 2.6. So it's not like you're only stuck at 1950 and the other things are growing. It's not quite as cut and dry as what this makes it seem. But just remember, 2.6 growth on 3432 is more dollars than 2.6 growth on 1950. It's just that simple. So the longer you wait to take your benefit, not only the more you're going to get when it comes to just pure number, you're going to get 32% more, but you're also going to get 2.6 cost of living adjustment according to this numbers we're using because what historically has been on top of that, which will give you 2.6 again on $3,000 is more than 2.6 on $2,000. And so here we go. If you claim at 62, that benefit age, remember, so let's go back. We talked, it was 1950, I believe. Yeah, 1950. If we claim at 62, with inflation at 2.6%, that 1950 goes to 2393. With inflation at the waiting till your full benefit, your FRA plus your delayed earnings credits is going to grow to 4214. So that's almost $2,000 difference than if you claimed at 62. I didn't explain that very well. So let me just tell you what I'm talking about. 1950 and 3432. What did they grow to with inflation? over the next couple of years. So 1950 and 34.32, 1950 grows to 23.94, 34 whatever it was grows to 42.14. 1950 over until you're 80 grows to 3,095, 30 whatever it was grows to 5,500. So you can see there's a $2,000 difference there. Now there's a $2,400 difference there. Look at that, $3,000 difference. So you can tell the longer you wait, the greater the divide grows between 62 and 70, delaying it. So again, I mean, my goodness, look at that. At age 70, with inflation, you're getting $23.94, which is almost $1,900 less than if you took your delayed earnings credits and had it adjusted with inflation. At age 80, you're getting $3,000, but here you're getting almost $5,500. At age 90, you get $4,000. Here you're getting $7,000. I mean, it just gets significantly more and more difference between when you take it and when you delay because of inflation. That's real money, my friends. Let's keep driving on here. One of the key points to remember, if you apply early, just like we talked about, your benefit starts lower and stays lower for life. COLAs magnify the impact of the early or delayed claiming. The longer you live, the more beneficial it is to delay benefits. It's just no getting around it. If you live beyond the age 78, you really should be waiting till you're 70 to draw. That's just absolutely. And then never mind if you have a surviving spouse. Decision impacts survivor benefits as well. So if you think you're going to live beyond 78, you delay. There's no other way around that, unless there's something that you need, like you don't have any other source of income. You're not quite sure if you're going to live beyond that, and so on and so on. But if the longer you delay, the better off you will be if you live beyond 78, and the better off your spouse will be as well. How can I maximize benefits? Critical, important one here. I love this topic because there's not a lot of things that are that difficult to do. Improve your earnings record. You look at your adjusted into average index monthly earnings. You go to SSA.gov, you sign in for an account, and you look to see if it's accurate. Are you missing some years? And I talk about this all my previous YouTube podcast or posts to talk about this stuff. You got to make sure your earnings record are tracking your reality. Can you improve it by working longer? So a couple things to remember here is remember, it takes the top 35 years of your earnings. That's what it takes. So let's say you only have 20 years because you're staying home taking care of the kids. Well, every other year you add to that earnings record is going to increase your benefits significantly because you have a bunch of zeros. You got 20 years in there, my friends, of earnings numbers, but the 15 of those are big fat goose eggs. Anytime we can eliminate a goose egg with real earnings is going to improve your benefits. And so especially for like stay-at-home moms or something like that, the longer you can work and get rid of those goose eggs that you had, the better off you're going to be Social Security-wise. Just no getting around that. But even if you say you had 20 years of making pretty good money, but the previous 15 you're shoveling snow. Well, every year that you advance to that you're making more money, now you're 63 years old and making pretty good money, that's going to wipe off that year you only made $10,500 shoveling snow when you're 27 years old. So every year that you have a good year, and again, it's going to be maxed, and I think it's 128.5 this year, 128,500 is a max there's going to be. So if you made 128,500 this year and 10,500, 25 years ago, and you can replace that 10,500 with 128,500 this year because of max, that's going to go a long way to increasing your benefits as well. So working can really help you significantly. We talk about this. Apply for Social Security at the optimal time. Your income needs, your life expectancy, your spouse's life expectancy. Not going to get to that too much here because we talked about that. The facts are that if you wait till 70, you'll be a better place. If you think you're going to survive beyond 78 and you want to leave your spouse with more secure income than wait until you're 70. Just no getting around that. All right, number 3. Annual earnings. This one's stupid. Everyone gets all caught up. I can't work if I'm getting Social Security. Yes, you can. You just get the money back. They do withhold benefits, $1 benefits for every 2 you earn above $17,000, but you're gonna get it adjusted at full retirement age. So don't sweat working because you're on Social Security. You don't lose those benefits forever, as some people seem to think. You get them back. You get them back when you hit full retirement age. So I just want to quickly touch on that. Coordinate spousal benefits. Oh, this is what I'm talking about. I tell you, this is where Elaine Floyd, who does this, really makes it's just fantastic. When lower earning spouses PIA is more than 50% of higher earning spouses PIA, both spouses should delay until they're 70 but one spouse should take advantage of the spousal benefits at full retirement age. So it's what happens. He's got to coordinate the ages and whatnot, but let's say you have a spouse that's 66, a spouse that's 62, or I should say a spouse that's 66 and a spouse that's 70. So I'm 70, my wife is 66, which actually would be the case. I get my benefit at 70 with my delayed earnings credits. My wife files for her spousal benefit, right? She files for her spousal benefit, which would be half of my PIA, and she allows hers to continue to grow. The problem with that, though, is at the end of the day, that is only applicable if you're born before January 2nd, 1954. So it's a challenge to do that anymore, because they're going to give you the max if you're not born before January 2nd, 1954 of whatever's greater, your spousal benefit or your own benefit. So that's a rule that's there for you. If you're born in these, you only got a couple years left to do that, but it's not going to work anymore for anyone's born after 1954. Lower earning spouses, PIA is less than 50%. That lower earning spouse should go ahead and just claim early. Absolutely. Where the higher earning spouse claims at 70. The critical thing is here, the higher earning spouse should claim as long as he can or she until they're 70 years old to get the max benefits with delayed earnings credits and cost of living adjustments, plus. So that way, when that spouse dies, the lower earning spouse will she'll get rid of her own benefit, or he, and step into the higher earning spouse's benefits for survivor benefit. So that's the critical thing. So take the lower earning spouses takes the benefit early just to get something going. The higher earning spouse waits till they're 70. The higher earning spouse then gets delayed earnings credits with inflation adjustments, which is significantly additional income to them. At death of the higher earning spouse, the lower earning spouse just steps into the benefit. That's not a bad deal, guaranteed. And it is always adjusted with inflation. Now, here's my favorite one: minimize taxation of benefits. If you've watched any of my YouTube episodes, you know how much I hate retirees paying taxes. Critical thing, we talk about this a million times a Sunday: provisional income. Provisional income determines how much of your Social Security will be subject to taxation. And so I've talked a lot about provisional income. I'll just give a brief tutorial on this right now. But it takes half of your Social Security benefit plus everything else you have. And they say, how much is that? If that amount is under $32,000 and you're married filing jointly, you don't owe any taxes on Social Security. If that amount is between $32,000 and $44,000, again, half your Social Security benefit plus anything else you have, to include tax-exempt interest, by the way, up to 50% of your benefit will be taxed. But in reality, it's only going to be, let's say your provisional income is $44,000. So $44,000 minus $32,000 is $12,000 times 50%. So only $6,000 of your Social Security benefit would be taxed there. It really becomes when you hit above $44,000 married filing jointly that you can start seeing significant taxation on your benefits up to 85%. No more than 85% of your benefit will ever be subject to taxation. That's a fact. So the first 15% is coming back at you tax-free, regardless of how much money you make. That's just all there is to it. So Social Security is still more favorably taxed than anything else that's out there for sure. Now, these numbers right here have not been increased at all since Bill Clinton raised a threshold in 1990, not raised the threshold, but raised a tax threshold from 50% to 85% in 1993. And this number right here has always been since Reagan started taxing Social Security benefits in 1983. So these numbers have not changed for inflation going back to the beginning when they started taxing Social Security. Spouse, if you're single, the same things are applicable here. If your provisional income is $25,000 or less, none of your benefits taxed. If you have provisional income between 25 and 34, up to 50% of that would be taxed. And the max would be, in that case, $4,500 of your Social Security benefit would be taxed. And if your provisional income is over $34,000, up to 85% of your benefit is taxed. So again, if you're single, you're going to pay more tax than if you're married filing jointly, just because the thresholds are higher for married filing jointly than they are for single, which goes again to what happens to widows. Yes, they might lose the lower of their Social Security, but they're still going to have higher provisional income if they have IRAs, because they're still going to have RMDs. And now they're going to be a taxable income as a single taxpayer as opposed to married filing jointly. They're only going to have one standard deduction. The tax brackets get dwarfed relative to a married filing jointly couple, and they're going to pay more on Social Security. It really ticks me off. Reduce other income with tax advantage investments, but not municipal bonds. We talked about municipal bonds go into your provisional income for sure. This is the big one right here, my friends. Convert traditional IRAs to Roth. That's what you got to do. Convert traditional IRAs to Roth while you're in the golden years of tax planning between the ages of 62 and 70, particularly. So what we want to do is avoid taking Social Security until we're 70. And during that time, start converting, because you have little income, especially if you're not working, start moving traditional IRAs to Roth. And I'm telling you, I got a video on this. You're talking 300 to 400% reduction in taxation simply by taking Social Security later and converting traditional IRAs to Roth. Now, reduced other income with tax advantage investments, I guess, I'm not sure what that would be. I guess qualified dividends at 15%. Long-term capital gains. But I don't even want that. I want this right here. I want more Social Security income and more Roth income and less IRA RMDs and less any other sources of income for sure. And reduce expenses. I completely agree with this. Is pay down debt. The number one thing you can do to go into retirement is have no debt, because you're guaranteed it. You're guaranteed a rate of return that says you have nothing owed to anybody. And it's just that simple. It doesn't matter what the markets do. It doesn't matter what the real estate markets do, because you still have a house to live in. If you can pay down debt, that is the number one thing you can do to go into retirement, because you have less outflow, which means you need less inflow. Less inflow means you have less taxes. So pay down debt. That's number one. Coordinate Social Security with the overall retirement plan. We kind of just did talk about that. We want to avoid taking Social Security until we're 70. And in the interim, start moving money from traditional IRAs to Roth IRAs. Absolutely. Now, if you have an annuity, for instance, and it's not in an IRA, I still want you to start pulling some of that money out. You don't have to, which is nice, because there are no RMDs, required minimum distributions, on annuities. However, if we can start if that's money that we're going to need later on, not a bad idea to start pulling that money out while your income brackets are low, the lowest they're going to be. Because once you hit 70 and the RMDs come, your tax brackets will start going up. And then once your surviving spouse survives you with a similar RMDs, the tax brackets are going to jump through the roof. Social Security personnel cannot tell you to project future benefits through scenario planning. That's where you got to talk to me or a financial advisor who does this stuff. They can't help you with innovative strategies designed to maximize benefits. They can't. They're going to tell you this is what you get and this is what you're entitled to now. That's it. That's what they're going to tell you. Nothing more, nothing less. And they're going to put on you to make that choice there for sure. Will Social Security be enough to live on in retirement? No, it won't. It was never intended to be. It's never intended to be. It's just because we're spending so much in our younger years on debt, on student loans, on big houses. Trust me, I'm just as big of a victim I'm big as I do this myself, without question, that people aren't saving enough. So more and more people are relying on Social Security as their primary source of income, which is why it's no joke, why no laughing matter. But it probably won't be enough to live on retirement. But I'll tell you, if you don't have a mortgage and you can wait till you're 70 to draw Social Security, and we already saw that lady had $4,000 a month in Social Security when you factor in waiting until she was 70 with cost of living adjustments. That's $50,000 a year almost right there. If you don't have debt, that can go a long way, and it's not subject to taxation either. We talked about this. Don't hesitate to work. My goodness, working and getting Social Security is not mutually exclusive. It's okay to work while you're drawing Social Security. The only thing is, if you're before your full retirement age, they are going to withhold benefits, but they're going to turn around and give those benefits to you once you hit full retirement age. So we talk about, working Social Security in context, required minimum distributions, all this stuff. You need to have a plan to work around, because the last thing we want to happen to you is to wake up and all of a sudden you're in a higher tax bracket because you did not do the planning. We don't want that to happen. Let's see what else. So again, this is the tutorial we do here through horse's mouth. But we certainly lots of questions to ask. When you should apply, what if you keep working, what if you already applied, how much, just all kinds of ways you can coordinate this. This is my favorite. How can I coordinate spousal benefits? And I'd add survivor benefits in there as well. And I'd also add some divorcee benefits too. I found a lot of my divorcee clients in my 20 years plus in this business had no clue they could draw Social Security off an ex's record. And I use this example. I'll use it till I'm blue in the face because it's so true. Just had a lady, ex-husband, after 10 years, I've been married more than 10 years, I said, you ever gone down and tried to file a benefit on his record? She goes, I didn't know I could do that. I said, just go down there. You can, absolutely. Now, we did not know what his record was, what his benefit was, but we knew that he made more than she. She went down there, and lo and behold, he was able to add $300 a month to her Social Security benefit, which paid for the long-term care insurance policy that she was really, really wanting to have, because she did not want her daughter to have to take care of her in a nursing home. And that was all based on, because because of what I learned here on this horse's mouth tutorial that I'm sharing with you through Lane Floyd about what you can do to maximize your benefits, even if you're divorcee. And she got free long-term care because it was paid for by Social Security off the earnings record of her ex-husband. That was one of the best things for me as a financial planner. I loved it. To this day, I love it. So that's it, guys. I hope this is helpful to you. Again, Josh Scanlon with the Heritage Wealth Planning YouTube channel. Please give me a thumbs up if you would. Share it. And my hair is all messed up because when I was doing this, I was pulling my hair out of my head. But as you're looking at your own benefits and you have questions, if you want to ask, by all means, fire away. You can ask me directly, privately, if you will, Josh at heritagewealthplanning.com. I keep looking at the mic when I'm back online here. Josh at heritagewealthplanning.com. Put them in the comments, if you will. Comments actually help me spread the word about the YouTube channel. Obviously, you don't want to get too personal. I get that. But, whatever is comfortable for you. Put them in the comments below. Email me directly. Go to the website at heritagewealthplanning.com. As always, don't forget to subscribe down there and then hit the notification little bell so you can be notified of future content that we do, because we love doing this content. It's fun. I like it. Hopefully it's informative, and I hope you get something out of this. See you next time on the Heritage Wealth Planning YouTube channel. Thanks.